Hey, listen, I quit. Yeah, I'm going into stocks.
Name of the game. Move the money from your client's pocket into your pocket.
But if you can make your client's money at the same time, it's advantageous to everyone, correct?
No.
No one is paying attention.
It's unbelievable.
Have to act now.
God, this is intimate. I feel like I'm financially inside of you or something.
Okay.
I have 5 houses and a condo.
I'm considering going long on April wheat. What do you think, Valentine?
Alright, so hi guys, welcome again to the channel. So for those of you who are new, this is the Greedy Trader channel where we talk about all things market profile, but we also talk about all things trading, liquidity, volume, macro, whatever it is that you need to know, we will be talking to you about on this channel. Anyway, my previous video, I covered a ton of stuff, especially around the topic of, is day trading worth it? So if you haven't seen that video, check it out, because before we dive into what I'm about to show you, which is how we avoid what I could reasonably describe as liquidity trapping, right? So how do you avoid that liquidity trap? Now, so you guys have probably seen a lot all over online, everyone talking about liquidity traps. Today, I'm going to tell you exactly what those are, what to look out for, and how you can take advantage of liquidity stacked around the board. Now, just a small note. Trading is difficult. It's difficult because psychologically most people are not where they should be with it, and as a result they're going to do things that they shouldn't be doing. The whole point of this channel is to steer people away from that, and hence why I'm now hugely focused on just making you aware that 99% of what you see on YouTube or around there is not true. So I'm just trying to bring an overall sense of awareness that you've got to be really careful with what you see. Now, what you're looking at today is a time price opportunity chart, or a TPO chart, or market profile chart, and I prefer to use that because, one, a lot of people ask me about anxiety, right? A lot of people ask me about how do I stop being anxious when I trade? How do I, just be in the zone, right? How do I do the things that everyone keeps telling me to do that I seem not to be able to do? Well, that's why I use a TPO chart, right? Because first and foremost, when you're looking at a market profile chart, even though the ticker is moving, you're not seeing that in a very graphical or visual way, in a very gamified way, which is what you get when you're using a candlestick chart. It is hugely gamified, and the problem with that is that when you see a lot of movement, you are prompted into action, and a lot of people struggle with that. So by using the TPO chart, it eliminates that. That's the first thing. Secondly, you see more detail, you see more information, right? And most of the decisions we make are going to be based on information. Now, and when we say information, I like to think there's no real edge in the data-based information. So for example, there's no edge in trading an NFP, for example, or there's no edge in trading earnings, or there's just no edge in that kind of information, because someone always knows it before you do. Now, there is there's an edge in social information, so maybe stuff that you see on like a social media platform that can translate into an investable opportunity. So for example, you might see something on social media about a particular brand, right, accelerating within a specific demographic. Let's say a specific brand doing pretty well with Gen Zs. That's social information that has not yet been discounted in, and that's because if a brand is already making strides and they're gaining traction, you're going to see it in the social space first, so the things around you. And just to give you a really cool example, right, and you should look this up, and I urge everyone watching this to look that up, is a company called Raytheon. The stock ticker is RTX, and one of the really cool ideas that I had about Raytheon going a few months back was the war in the Middle East kicked off, and one of the things that we use a lot in our military arsenal is Tomahawk missiles. They get fired out of naval ships, so I think they come out of destroyers, right? And the US uses a lot of those, and many other countries that have naval powers use these kind of missiles. So I had the idea that if we're gonna go into war in the Middle East, the typical weapon of choice has always been Tomahawk missiles, and that means that more Tomahawk missiles are going to need to be purchased, and they're going to need to be since this war was very sudden, they're going to need to be purchased across into maybe 2027, 2028, right? So they're going to have more stockpiles of Tomahawk missiles. So my idea was that if that's going to happen, since Raytheon is the primary distributor of Tomahawk missiles, then we're going to see this in Raytheon's earnings at least down the line, if not straight away. So because there's going to be a ramp up of orders. I think a Tomahawk missile costs about $2 million, right? And we're not talking about other things like maintenance and so on. So right out of the gate, I can see that Raytheon is going to do pretty well as a defense contractor. So it made sense to particularly start looking at Raytheon stock as an investable opportunity, right? So that is like a social play, right? It's a social arbitrage because it has not yet been factored in to the information sphere. Now, if you're not dealing with information in this way, which most of the time you can't with currency markets, I know you guys love Forex, so the example I was going to give was Forex. Most of the time you can't factor that in. And because you can't factor in that kind of social information, there is no information edge. So stop looking at little bits and pieces of information, data, whatever, to formulate trading opportunities.
Ask one other question, Mr. President. If I may ask one other question, are you worried?
That's enough. That's enough.
Mr. President, I was going to ask one of the other folks.
That's enough.
Pardon me, ma'am. Mr. President.
That's enough.
That is just not going to work. Now, instead, what you need to focus on, and you need to continue to focus on, is liquidity. Right? So, where's the liquidity, and where is the statistical information edge? Right? And that's why I use market profiles for the statistical information edge. And what do I mean? I mean that, for example, if you take a look at this section of the screen, you can see this profile here is a little bit thicker. Right? That tells me there are offers standing up here, and that's an area of resistance. Now, that is information that not everyone can see, right? If you got a basic candlestick, well, you can't see that. So for me, it's an information edge, but it's statistical because it's a statistical benchmark, right? To see what I like to call offer stacked is a statistical play. So I can see where the order flow is building, and that's going to be likely where passive orders are going to sit. And that was proven because in P period on this profile, you can see we pulled into that, hit those offers, and then we pulled back out again. So this was relevant information. Now, if you were a trader trading long, or you were going to trade a breakout here, for example, straight into liquidity, you would have been in trouble because not only did we get a liquidity on here, we also were trading into an offer stack, right? So it's going to increase the likelihood that the market's going to reverse. These are the things that we need to know and we need to be able to see so that we can take advantage of it. There are other pieces of information across the market profile framework. I'd love to cover them all, but I'm not going to do that on this particular video. We shall leave that for another video. Let's reverse. What's going on today? So I've got a chart of cable up. Now I know you guys love Forex, and it's totally okay. I'm not a huge advocate. Like, if you are new to trading and you're a beginner, I'm not advocating you start to trade with Forex. That is not where you want to go to learn. I think it's always best to start with these asymmetrical markets like the stock market to learn. It's a better medium for you to learn and understand the inner workings of a market before going on to symmetrical asset classes like currencies, commodities, even indices. Alright, but anyway, I know you guys love Forex, so we're going to talk about Forex. We're going to use Forex as the example, but you will look to operate this way on any market that you come to. So in the prior video, we talked about the liquidity areas, so they were clearly defined. So we can see here that there was a low T period low, and that means liquidity would rest below that. What do I mean? It means that we're going to have an abundance of sell stop losses and sell stop orders. Traders who are looking to trade breakouts are going to trade with sell stop pending orders to go down, and traders who are looking to stop themselves out of a position are going to position sell stops, usually at prior lows. So this tends to be an area where we're going to see a lot of liquidity, and that's kind of where we want to pay attention to, because once we get a reaction out of that area, that is where we look for our execution. So example, we have the T period low, and then you see us trading. So we took out liquidity under J, so we get the hour period move to the upside. And what do I always say to guys? That trades that take place in major sessions are the ones you want to pay attention to. And when I say major sessions, we're talking about the Nasdaq Open, the Chicago Open, to some degree the London Open, providing we are trading at a major discount. By a discount I mean if you took a swing from top, say for example the T period high to this LQ period high, then mid-range would be value, the underside would be a discount, right? So that means that if we're trading somewhere in a London session, which sometimes is quite rare to be trading a discount in a European session, but let's say we are, then you could trust your execution in a European session. But first and foremost, our best opportunities will come in the New York, Nasdaq, or Chicago Opens, specifically the Nasdaq Open. In fact, I wouldn't even do anything if I don't see that Nasdaq Open, because it really doesn't make sense. And a good example is what we just saw today. But we're going to talk about that. But for now, let's start with the basics. Let's crunch down back to the basics. So we've got the T period low. Our period, we trade just below that T period low, take out the stops, and then we close up, right? So our execution has to be somewhere within this dynamic value low, and that would be looking for targets above liquidity to the upside, right? What does that look like? So we can see here that we have a liquidity top at C period, so we expect the market to trade above that. We have value high sitting just at 127.33. we have another liquidity high at P period, and we have the ultimate liquidity high just above 127.77, or we could be trading easily the 127.70s. You can see there's an offer stack there. We had met resistance at that offer stack, so again we talk about offer stacks, and then we pull back, so that becomes the liquidity to beat. So this market is going to keep going upwards. We have to first trade and take out the stops of the liquidity high. There's going to be quite a few P period, and if we split this profile, there'll be some above Q and L period as well. So this is a really good area for the market to target, and there's no doubt in my mind that we're going to target there. And that's where we also start thinking about the longer time frames, the macro picture. So what do we get? Our period, we traded back. Why we don't trust the European session? If you look at it here, it's 8 a.m. London Open, or let's say even 7 a.m. London Open. JNK period, there was nothing going on. When did the breakout come? New York Open. P period, continuation in Q period into the Nasdaq Open, which is kicking off right now. Now, again, this will likely add more fuel to the fire because we can clearly see that they're liquidity highs. So if you want to make a trade, you shouldn't have been doing it now. In fact, that trade should have come yesterday, 3 p.m. our period, Chicago Open, a little bit after, and that means you're looking at an overnight risk trade. How do you manage that? Incredibly simple. Once you close overnight, roll your stops just below the lows of R period, so you've got very tight risk, or even S period, and then hold there. That's protection overnight. As you can see, we started to push back up in the US session, and you would be in a positive trade. So liquidity is important because, again, we cleared the T period low. Now, had we not done that, then there would be no trade. And every time we clear out these liquidity lows, there's an opportunity. Till my next video, guys. Adios.
Hey, listen, I quit. Yeah, I'm going into stocks.
Name of the game. Move the money from your client's pocket into your pocket.
But if you can make your client's money at the same time, it's advantageous to everyone, correct?
No.
No one is paying attention.
It's unbelievable.
Have to act now.
God, this is intimate. I feel like I'm financially inside of you or something.
Okay.
I have 5 houses and a condo.
I'm considering going long on April week. What do you think, Valentine?